Hi and welcome to Swissco's Daily Market Talk. It's Friday, March 14th. Another week of hectic tariff news is coming to an end with Trump announcing 200% tariffs on European wine and champagne and other alcoholic beverage makers. Cheers to that. So futures are in the positive this morning on rising hope that the US will still avoid a government shutdown, but beyond that, well, nothing really looks like a good reason to return to the US markets. So yesterday was yet another day of escalation in the trade war. This time, Donald Trump was apparently totally annoyed by the fact that the Europeans responded to the 25% steel and aluminum tariffs instead of retreating. He found that abusive, according to Lutnick. Abusive, he said. It is unbelievable. Yes. So, to show an example of a reasonable and not an abusive move, Donald Trump decided to impose 200% tariffs on champagne, wine, and other alcoholic beverages that come from France and the European Union generally. Now, of course, at this point, we can only laugh at what's said and what's done on both sides, especially in the White House. It is needless to say, however, that the French beverage makers found the escalation not so funny. The losses were variable across beverage companies. LVMH, for example, the owner of Moet Chandon and Veuve Clicquot slid 1.1% yesterday, while Rémy Cointreau tanked straight to the bottom. The company lost more than 4.5% yesterday and is now trading at almost a decade low level. The CAC 40 in France fell 0.64%, and in Germany the worries came, but they came under a different form. The clash between the new PM-to-be Merz and the Greens there make a massive spending deal on defense look more complicated than many imagined previously. And the uncertainties regarding the extent and the size of this infrastructure and defense spending and how it will meet the climate goals weigh on sentiment across the European stocks these days, but the STOXX 600 index has beautifully resisted to a slide below its 50-day moving average this week, and any positive news from the German political front could actually reboost sentiment along with the declining natural gas prices in Europe on the expectation that there could eventually be a resolution to the war between Ukraine and Russia that could lead to restoration of gas flows to Europe and eventually mark the end of a terrible energy crunch on the old continent. Obviously, this is not a political show and I'm not a political analyst, so I won't be commenting on the terms and the implications of any resolution for the Ukrainians who will probably be asked to make some undesired concessions to buy peace, but it will obviously be very interesting to see how the European governments will react to a development that could sacrifice Ukrainian demands for cheaper energy prices that are very much needed to allow these economies to return to growth. And especially that's the case for Germany, that has been suffering big time from the energy crisis due to this Ukrainian war. Anyway, elsewhere in the energy space, crude oil was down at yesterday's trading session on the back of the escalating trade war that deteriorates the global demand outlook, while the OPEC plus countries are preparing to restore their oil production from April on due to the US demand. So the growing gap between the demand and supply outlook, well, that hints that the market will be in a deeper supply surplus situation later this year, as it is also suggested by the IEA. Now note that the US is also gently increasing its own oil production on Donald Trump's drill baby drill demands, and the whole thing is obviously negative for oil prices in the medium run. Now, this morning, crude oil prices are a better bid. They are boosted by the news that the US tightened sanctions against Russia and Iran. But I believe that the macroeconomic factors will be weighing heavier on the sentiment than the geopolitically led moves, and the price rallies that we see in oil are perhaps interesting opportunities to strengthen short positions for the medium run in crude oil. The worsening global trade outlook due to the tariff chaos and Trump's drill baby drill policies, and the expectation that the OPEC will be restoring production throughout the year could eventually push the barrel of US crude toward the $45 to $50 per barrel range later this year in the second half. But the weak energy prices are having a desired easing effect on inflation, and that's good news. This is what yesterday's US PPI data stressed out. The producer prices fell in the US in February, both the core and headline PPI figures, and for both monthly and yearly basis came below the market expectations. Alas, the sight of slowing factory gate inflation in the US couldn't cheer investors at yesterday's trading session. The S&P 500 extended losses to more than a 10% slide since the February peak and is now officially in the correction territory. Nasdaq 100, on the other hand, lost some 1.90% yesterday. Interestingly, though, losses at Nvidia remained well contained to just around 0.14%, while Intel jumped 14% yesterday after the appointment of a new CEO and on the expectation that this new CEO will make bold moves to turn the company's fortunes around by, for example, separating the company's foundry and design businesses and partner up with leading industry players like TSM and Broadcom, for example, to unlock value at these domains. Some analysts start considering improving their recommendations as well for Intel, but the challenges could make recovery slow and bumpy for Intel, and the market conditions are no longer ideal either. Even this week, softer than expected inflation numbers from the US couldn't give a smile to major US indices, mind you, and that tells a lot. And that is, well, certainly because investors today are more concerned and increasingly concerned about the rising inflation expectations due to tariffs than the actual inflation numbers themselves. This is what the data this week and the market reaction told us. And this is because inflation expectations tend to be self-fulfilling. So a significant slowdown in consumer spending in the US could eventually temper these inflation expectations and limit the impact of the tariff chaos on the actual prices. But the latest inflation expectations readings had told otherwise. So today, all eyes are on Michigan's consumer sentiment and inflation expectations update. Signs of further heating in inflation expectations in the US could further weigh on investors' appetite and reverse the early optimism that we have been seeing since this morning across the US futures, which is mostly due to the expectation, the hope that the US politicians will at least find an agreement to avoid a government shutdown in the US. In the FX, the US dollar has rebounded this week from oversold conditions that resulted from a sharp sell-off since January, backed by rising worries of a sharp US economic slowdown and mounting bets of a possible US recession later this year. And the equity sell-off in the US hasn't improved inflows toward the US dollar so far this year, as money doesn't only leave the US equities, but it also leaves the US equities in favor of other markets that are denominated in other currencies. And the rotation toward the European equities has certainly been one of the most significant and popular trades of the year. So that kind of explains why the US dollar is weakening along with US equities. As such, the euro dollar tested the 109 offers earlier this week, but failed to extend its attempts to the 110 psychological mark, somehow laid back by the overbought market conditions there. But the outlook for the euro dollar remains positive on the back of converging growth expectations between the two continents, meaning a slower growth for the US and a faster growth for the European economies. But the Eurobulls will certainly watch the developments on the German political front before they refresh their push to and above the 110 psychological mark. And that could be as soon as next week. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn, and also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.